Hi everyone, I'm Kingsley. In this video, I'm going to talk about financial accounting process. In my previous videos, I talk about what is accounting and its two main branches, financial accounting and management accounting. Accounting is considered as an information system that provides meaningful information for decision makers to make rational economic decisions. Accordingly, accounting can be considered as an information system. As an information system, financial accounting also has three components of an information system. It has input, a process, and output. As far as input is concerned, financial accounting has two types of inputs, transactions and events. A company purchased a motor vehicle for $25,000 can be considered as a transaction. Or part of the inventory worth $10,000 damaged due to an accident, it can be considered as an example for an event. So both these transactions and events are considered as input to financial accounting process. These transactions and events are then processed into a meaningful information. So process involve identifying transactions and events. So we identify transactions and events with source documents such as debit note, credit note, invoices, vouchers, etc. So these source documents provide raw data about your transaction. So the transactions and events that are identified with source documents are then recorded in a place called daybooks or journals. For example, company purchase goods on credits, so can be recorded in a place called purchase journal. So purchase journal shows all the credit purchase of goods during the period. So transactions and events that are recorded in the journals are then classified in a place called ledger. So ledger is a place where you maintain accounts. So ledger is a collection of ledger accounts. In the ledger, we have five types of accounts. We have asset account, liability account, income account, expense account, and equity account. Transactions and events that are recorded in your day books are then posted into this ledger. So the moment you post your transaction into the ledger, according to double entry principle, it automatically classified as asset, liability, income, expense or equity. So with these classified accounts, with these classified account balances, we can prepare summarized financial statement. So this summarized financial statement includes statement of cash flows, statement of changes in equity, statement of financial position, and statement of profit or loss and other company's income. So these summarized financial statements are then required to be analyzed in order to get a meaningful idea about the company's financial result and financial position. So this interpretation involves analyzing financial statement using techniques such as accounting ratio analysis or trend analysis or horizontal analysis or vertical analysis. So we can use different types of techniques or tools to analyze company's financial result and financial position and interpret the company's financial status. So then through this process we have key output called general purpose financial statements. So general purpose financial statements are the key output of financial accounting process, which includes statement of financial position, statement of profit or loss and other comprehensive income, statement of cash flows, statement of changes in equity and descriptive notes. So this is what we call financial accounting process. In the next part, we are going to talk about uh, these processes in detail. Identifying transactions and events is the initial step of financial accounting process. We identify transactions and events with source documents. Source documents are the documents that are generated at the time of occurring transactions and usually provide raw data about a transaction. Data such as date of the transactions, the consideration or the value of the transaction, the related parties' name and addresses, and the terms and conditions of the transaction. So these raw data provide as input to the financial accounting process. So for example, we have invoices, vouchers, receipts, debit note, credit notes as example for source document. So we need to identify each and every transaction occurred in an organization with a supportive source document. If you do not have supportive source document as proof evidence about the transaction, then you are not authorized to enter those transactions in the accounting process. So accordingly, we need to first identify transactions and events with these source documents. Transactions that are identified with the source documents are then recorded in the place called daybooks. Recording transactions and events in the journals or daybooks is the next step in the financial accounting process. Transactions and events that are identified through source documents must be first recorded in the daybooks or journal before they are posted into the ledger. There are two types of journals: special journals and general journal. Special journals are the journals that are specifically, exclusively maintained to keep recording special kind of transaction. For example, an organization can maintain purchase journal in which you can keep recording all the credit purchase of goods with the intention of resale. In addition, you can use a cash book to keep recording cash receipts and cash payments, and sales journal to keep record all the sale of goods on credit basis. In addition, a company can maintain general journal that will accommodate any kind of transaction. Usually, transactions that are not recorded in a special journal are recorded in a general journal. We will now consider an example for purchase journal. So purchase journal is a journal where you keep recording credit purchase of goods with the intention of resale. The format of this purchase journal can be decided by the management. For example, if you wish to know about the details about the types of the goods you purchase, quantity you purchase, etc., you may add those descriptive columns to this purchase journal. We will now consider one transaction. Let's say 1st January we purchase goods from a supplier called Pereira, goods for $5,000. You can keep recording it like this. So we'll say 8th January we purchase from a supplier called Silva, goods for $8,000. We can keep recording like this. So 20th January from John we purchase goods for 12,000. So you can keep recording all of your credit purchase in this purchase journal. Keep in mind the source document to recording this transaction in the purchase journal is the purchase invoice. So using the purchase invoice you can find out the relevant data to be included in this purchase journal. End of a particular period, maybe end of each week, let's say usually end of each month, we can add the purchase journal total 25,000. This purchase journal total can be debited to the purchase account or sales inventory control account, depending on whether you are maintaining perpetual inventory control or periodic inventory control. We can debit to purchase or inventory control, and we can credit this total to the creditors or trade payables account. So this debit and credit entry is taken place in the ledger where you classify your transactions and events. Classifying transactions and events is the next step in the financial accounting process. Classification of transactions and events takes place in the general ledger. In the general ledger, you have 5 types of accounts: asset account, liability account, equity account, income account, and expense account. The moment you post your transaction into the ledger accounts using the double entry principles, it automatically debit into one of these 5 accounts and credit into another account. So accordingly, your transactions automatically classified under 2 of these 5 baskets. In the previous slide, we talked about credit purchase. So credit purchase journal or purchase journal total, we can debit into inventory account or purchase account and credit into trade payable account. So you can see that particular total credit purchase ultimately classified as an asset and liability. So using these ledger accounts, then we can prepare our summarized financial statements. In the ledger accounts, we have 5 types of ledger accounts: asset, liability, equity, and income and expenses. Using income and expense account balances, we prepare income statement or statement of profit or loss and other comprehensive income. Using asset, liability, equity account balances, we prepare a statement of financial position to provide information about company's financial position. Summarizing transactions and events through financial statements is the next step in the financial accounting process. In the general ledger, we have 5 types of account balances. Out of these 5 types of account balances, we take asset account, liability account and equity account balances, and we prepare a statement of financial position to provide information about the company's financial position as at a given date. And there are 2 more ledger account balances in the general ledger: incomes and expenses. By using the incomes and expense account balances, we prepare a statement of profit or loss and other comprehensive income that provide information about financial result or profit of a business. So a statement of financial position provide information about the financial position of a business. A statement of profit or loss provide information about financial result or profit of a business. So with these components of financial statements together with other components such as cash flow statement, statement of changes in equity and notes to the accounts, we provide meaningful information about the company's financial result, financial position, cash flows and changes in ownership equity to the interested parties.